There is so much uncertainty with respect to how AI is going to play out. There is uncertainty about some of the micro fundamentals, earnings recovery. Is it going to happen? How fast is the growth for FY27 going to be? And there is also this debate about overall secular story, a structural story of India, whether the demographic dividends will become a demographic curse. So all of these things are conversation points. Where do you think uncertainty is directly challenging growth today, where we need to sort of go back to the drawing board in terms of assumptions we make, which so far we've taken for granted?
You look at the amounts of money, hundreds of billions, approaching $1 trillion being spent in capex a year. When so much money is being spent, there would be massive high likelihood of massive transformation. Okay, sometimes maybe, I can't think of many such examples where such massive amounts went completely down the drain. Yes, stocks may lose a lot of value because companies spending this money may or may not make an adequate return.
If I were to give you one statistic, the 155 shells, which basically are used, then if one were to replenish the shells that have been used so far in various conflicts, just to the normal inventory levels, which before, in peace times what are maintained, it would take the current global capacity, it will take them 3 years. So what we are seeing in Indian defense is an opportunity to also kind of, create that, de-risk their business away from only being suppliers to Indian defense to also being part of the global supply chain. That is one.
Hey guys, my name is Nikunj. I am a client with PMS AIF World, I think so now since couple of years. I'll just like to take a couple of sentences which I feel is very, very important while I describe them. So I got in touch with them 4 years back, but amazingly their advisors never change. Their advisors, they stick to their core principles really, really well. So what happens is that you can be rest assured that the advice that they are giving you will remain the same even if you go to them for the next 2 years per se, right? Second, which I really like something about them is that there is a personal touch. Every case is discussed very, very in length per se. Every investment is thought through. Every time they ask you what your current situation is, they look at the market conditions and then they ask you to invest somewhere. My pleasant experience has been with them is a couple of times they asked me not to invest for the next 3 months or so, right? So nobody will give you an advice not to invest when their main business is investing per se, right? So my trust with them increased tenfold when they told me that, and their touch with their advisors have turned out to be gold till this point of time. So best of luck to you guys and to PMS AIF World both. Thank you so much.
Welcome back, everyone. It's now time to move to a question that is both timely as well as thought-provoking. How reliable is growth investing in times of uncertainty? Growth investing has historically created immense wealth, but when volatility rises, liquidity tightens, and global uncertainty clouds visibility, investors often question whether growth remains dependable or whether valuation risks begin to outweigh opportunity. Is growth still the most powerful compounding engine, or does uncertainty demand a more nuanced framework for identifying sustainable winners? This session will examine how experienced investors adapt their growth strategies across cycles and where conviction should lie today. And we are indeed very honored to have an exceptional panel of seasoned investors. I'm going to now take a moment to introduce them to you. We have with us Mr. Sandeep Daga, founder, managing director, and CIO of Nine Rivers Capital. He brings over 30 years of experience spanning private equity, public markets, and corporate finance. Nine Rivers Capital was founded as an independent, no-conflict asset management boutique with a strong legacy in both listed and unlisted investing. And previously, Mr. Daga was a partner at Frontline Ventures and head of B2B investments at ICICI Ventures, known for his ability to identify emerging trends and high-performing companies early. He combines deep institutional networks with rigorous investment discipline. We have on the panel Mr. Prashant Khemka, founder of White Oak Capital, leads one of India's most prominent global investment management firms with assets exceeding rupees 1 lakh crores. Now, before founding White Oak, he spent 17 years at Goldman Sachs Asset Management, where he served as CIO and lead portfolio manager for global emerging markets and India equities. With a distinguished global investing career that began at State Street in Boston, Mr. Khemka has consistently delivered top-ranking performance and built strong international credibility in growth investing. We also have with us on the panel Mr. Arun Subramaniam, founder and managing partner at Ampersand Capital, brings over 3 decades of experience in Indian equities, and prior to founding Ampersand, he was part of Bank of America Merrill Lynch's institutional equities team and was consistently ranked among the top auto analysts by Institutional Investor. At Ampersand, he leads a research-driven platform focused on long-term, sustained outperformance. And now, moderating this insightful discussion is Ms. N. Mahalakshmi, Senior Consulting Editor at Money Control, and with over 25 years in financial journalism and prior leadership roles at Outlook Business and Business Standard, she has interviewed global investment icons including Warren Buffett, Howard Marks, and Joel Greenblatt. Her deep understanding of markets and investing frameworks makes her ideally placed to lead this conversation. So we're very grateful to you, panelists, and our moderator for being here with us. Ms. Mahalakshmi, it's over to you for what promises to be a rich and nuanced discussion on growth investing in uncertain times. Take it away.
Thank you so much, Aishwarya, indeed for that beautiful introduction about all the panelists. I'm super excited and thankful to Kamal and the entire PMS AIF team for having me as part of this discussion. Thank you so much for the opportunity. This topic, how reliable is growth investing in times of uncertainty, as Aishwarya mentioned, is very, very topical. Only that in the last 25 years, I have come to one conclusion that all investing, whether it is defined as growth or value, it is all about buying an asset at a price lower than what its intrinsic value is. And its intrinsic value is supposed to capture everything from past reliability to present fundamentals to future cash flows. Everything is embedded in that. It is just that people make different assumptions about future growth. They perceive uncertainty differently. They perceive growth differently. And that is how they play their convictions in the market. So therefore, in this discussion, I was thinking of just bifurcating this whole debate, discussion points around 3 points. Where is uncertainty? And defining uncertainty in today's context in a way that directly challenges certain growth assumptions. So my first lead point is, and we can start with Prashant. Please tell us, we have been hearing, and at Money Control, we've been reporting there is so much uncertainty with respect to tariffs. There is so much uncertainty with respect to how AI is going to play out. There is uncertainty about, some of the, micro fundamentals, earnings recovery. Is it going to happen? How fast is the growth for FY27 going to be? And there is also this debate about, overall secular story, a structural story of India, whether the demographic dividends will become a demographic curse. So all of these things are, conversation points. Where do you think uncertainty is directly challenging growth today? Where we need to sort of go back to the drawing board in terms of assumptions we make, which so far we've taken for granted.
Oh, thank you, Mahalakshmi. And are you able to hear me, Mahalakshmi?
Now I can hear you.
Okay, sorry about that.
Now we can hear you, yeah.
So I was saying thank you, and good morning, everyone. So there's at all times uncertainty, but yes, and I've always said that current day uncertainty is no higher than what it was last year or the year before or 5 years ago and so on. But for the first time, it does feel to me that we are in a somewhat heightened, degree of uncertainty, primarily as it pertains to many of the business models that were long established and considered very robust, whether growth or value, not necessarily that crucial, but it's just the assumptions for across businesses. Many of the businesses are getting questioned and should be questioned. So it reminds me, I had the good fortune of being an investor and managing portfolios in the US during the dot-com bubble from 98 to 2006. So there's a often strong sense of deja vu when so many businesses we would discuss in our meetings then. Media, for example, this live streaming, Zoom was nowhere there, right? It came during COVID. So live streaming, there was this thing called video on demand, and people would be like, who would want to wait, for 2 hours? Okay, if you want to watch a movie tomorrow, then you can start downloading today and it'll buffer and then you'll watch tomorrow. So the cable TV and the broadcast stations are all safe and whatnot. And over the years, obviously there's been tremendous progress. So what we see in its present form, AI, would be dramatically, obviously not all the forecasts and projections on how it's going to evolve would not turn out true, just as for internet might not have turned out true. But it would be tremendous if you look at the amounts of money, hundreds of billions, approaching $1 trillion being spent in capex a year. When so much money is being spent, there would be massive high likelihood of massive transformation. Okay, sometimes maybe, I can't think of many such examples where such massive amounts went completely down the drain. Yes, stocks may lose a lot of value because companies spending this money may or may not make an adequate return. That's a different matter. But in the real world, there'll be very, very far-reaching implications. And at this time, I think it would be somewhat naive, in my view, to have very strong conviction in anything. Yeah, you should. Well, I have the older I've grown, the less conviction I have in anything. I had the strongest conviction when I was a teenager investing in markets, and over time, markets taught me. Because my biggest mistakes have been where I've had the strongest conviction. So we anyways invest with doubt rather than with conviction. And at this time, I think it would serve well to be very doubtful of everything, very skeptical of everything. And on either side, neither to get too pessimistic on something, nor to get too optimistic on something, because the degree of uncertainty is related to AI particularly. I'm not so worried now. And usually I think that worries like tariffs and geopolitical, unless there is some tail risk event that happens, those are usual part for the course. At all times they're present. They come and go. But AI is like once in a generation kind of risk. The last time there was something of this magnitude, or maybe even stronger, because AI I see it as an offspring of internet in some forms. So internet was a massive, internet plus mobility, the combination was a massive disruptor to a lot of businesses. And this, after about 25 years or so, there is a disruptor of that kind of magnitude or potential impact. So that to me is the biggest source of uncertainty. And when I say uncertainty, it could be positive and negative. For many businesses would be positive, for many it could be negative.
Fair enough. So true that, Prashant, no wonder there is this proverb called a wise man is always in doubt. So it's a wonderful thing that you grow more doubtful as you become more experienced. Be that as it may, have a bunch of questions on what you talked about. But meanwhile, Arun, can you step in on how do you look at uncertainty today? Are you able to clearly, what I take away from Prashant is, AI being a key big disruptor. Tariff is par for the course. It's something, a kind of uncertainty we can live with because it's present at all times. How do you see, and where do you see the growth assumptions being challenged very seriously because of prevailing uncertainty?
First of all, good morning to all of you. What I agree with Prashant is the fact that he actually delved on the AI challenge, and I agree with it in the sense that I don't understand it, and since everybody is saying the same thing, so I might as well believe it. But beyond that, I think 2026 compared to 2025, India as a nation and our stock markets in general should have are getting a lot of tailwinds, whether it is in terms of the growth data, whether it is in terms of tariff getting resolved to a large extent. The only thing probably still a big question mark is how the foreigners are viewing India in terms of valuation. And obviously, a lot of money is actually still being taken out of the country, and that's obviously a bit of a risk. But that same thing happened, the money part happened in 23 and 24, and obviously it got offset by this huge inflow of domestic money, which still continues. To that extent, I think uncertainty has come down. But yes, what the AI situation is going to, how it's going to pan out, and not just the IT sector, but all the related sectors which actually get disrupted because of that. At this point in time, I'm not an expert enough to understand, and I would probably believe that some of that will get offset by that. So as far as I'm concerned, I think, and our fund is concerned, we are viewing this period as a period of becoming more constructive on markets, and we think that the uncertainty, so to speak, in some sense, actually dissipating a bit. And this AI situation also, like I said, if I may add, and I'm not, like I've already added with the caveat that I'm not an expert, I think it's slightly overblown. I'm actually taking a risk by saying that, because that basically means I'm taking a view on it. But the fact that it is actually so many people are talking about it and so much is already happening in the markets, we think that by the time it actually pans out or whenever it happens, things will get adjusted or resolve itself, I think.
Right. Sandeep, can you, so Arun, the way I have understood it, you are saying I'm keeping aside AI, although you have expressed a view that it is slightly overblown, but you're keeping it aside and saying otherwise uncertainty is actually dissipating, so you're becoming constructive. Sandeep, do you hold the same view? Do you see any pockets or sectors that growth is really challenged, and do you think overall uncertainty, and let us keep us, you can express your view on AI, but is it overall receding or increasing?
Yeah, so at the outset, thanks to Kamal and PMS AIF World for having me over. So, just, taking leaf from both what Prashant and Arun said, I would just add that the world, in addition to I would say AI impacted or AI infested, whichever way you want to take it. There is also this whole confluence of various geopolitical factors, globalization being thrown out and localization coming in various geographies. So all of this is actually contributing to the uncertainty. It's just in the last few weeks since the Anthropic Cloud event that AI has taken center stage. And our belief is that India particularly will benefit out of a lot of these uncertainties that are playing out. Primarily because there is on the ground, when we speak to companies and businesses, we see that a lot of supply chain realignment that is happening, bodes well for Indian manufacturing. And that is unlikely to be impacted by AI, at least in the next 3 to 5 years. Rather, AI is creating manufacturing opportunities, be it on the energy side, or be it going into certain specialty chemicals, etc., which basically ultimately go into the whole AI infrastructure build out chain. And on the other hand, as the global defense spending is shooting through the roof everywhere, and again our supply chain is going to, I mean, Indian manufacturing is going to become a part of that supply chain, and that definitely is a tailwind available to us. And so far we've done a good job of balancing our position, with east and the west, if I may, or north and the south. So that is what is, I would say, the green shoot that we clearly see. The hope is that that will continue and that will give that impetus to the growth in otherwise uncertain times. AI, I believe, is going to impact all of us in every way, whichever way you can think of. It is basically a democratization of consumption of products and services. We will have, Prashant said, we will have businesses that will benefit out of it, and businesses who would face possibly they may even have they may have existential crisis also. So So you have to look at it as you go every day. You have to see what's happening. And I also agree with Arun a bit, and this is also based on some conversations that we have had with the ultimately, one of the largest fraternity which consumes technologies, banking. So we spoke to a bunch of bankers at the very senior level who actually take these tech decisions, and what we realize is that while they are obviously looking at AI and they know that AI is going to help them, but they're also extremely worried of what disruption can AI do in terms of breaching their security. I mean, breaching their systems, or tomorrow data leaks, etc., etc. So I would say that we will have to wait and watch, but I will tend to agree with Arun that a little bit of fear mongering around AI is unwarranted. Of course, it will have a huge impact on our lives.
Fair enough. Prashant, back to you. The moot point you made was that you will, in today's heightened environment of uncertainty, you would approach pretty much everything slightly with a sense of doubt. Where do you see, where do you see that today you have to pay a little less than whatever you would otherwise pay in the market, given that there is heightened uncertainty? In other words, are you revisiting some of your valuation assumptions, or the way you value a sector or a stock, because there is uncertainty about growth?
Yes, and certainly not just about growth necessarily, but just the strength of the business model. Yeah. So let me again just give you some analysis. First of all, despite whatever I said, uncertainty and all, personally, I remain 100% invested. I can't stand a single day being a single percentage point of my whatever little money I have outside of equity market. So that's always been true. Someday it can change. I can't, commit. But as of now, no, our portfolios are 100% invested. We don't take any cash calls. So uncertainty from a stock specific level, from a market perspective, we think markets, smart enough to factor all these. Is there opportunities as well on one end, uncertainty as well? See, uncertainty, when I say, look, there are only few times in my career, at least I've seen, or over decades, where there is, as I think Sandeep used the word, existential risk to certain companies. Yeah. So certain times like global financial crisis, there was massive existential risk to a lot of companies. Then COVID for a brief period, but there was a massive existential risk for many companies. The dot-com bubble burst. After that, there was a massive existential risk to a segment of the market like telecoms and other capital heavy in US and elsewhere. So we aren't at that acute point right now, but depending on how this evolves, there could be pockets there where there can be existential risk, like in the dot-com time period, right? Newspapers were hundreds of years old businesses, the safest, strongest, maybe somewhat modest growing. And it was like almost unthinkable that a person in the morning would not want to open a newspaper with his cup of tea, coffee, or without a cup of tea, coffee, right? Warren Buffett has obviously, praised the business model, invested for a long time, and there are so many strong followers. I mean, some asset managers were gung-ho 50-60% in newspapers when they cracked because it seemed great value. I'm saying one should be open. One should have an open mind that the long-held beliefs, we should not necessarily just hold on to them because they've proven right in the past. We don't, on the other hand, debunk everything and throw everything. Because there are many times fears come and nothing come to pass. I mean, take our IT services itself. Y2K was supposed to kill it, then cloud was supposed to kill it, then something else was supposed to kill it. Yeah, so that's not what the suggestion. So just be more open-minded to the risk is what I'm saying. And yeah, to your point, there's a new dimension of there's always invested doubt or skepticism. Now there's an additional. So you have risk from regulatory risk, let's say management execution risk, let's say competitive risk, substitution risk. Now you have to also think of what is there an AI risk? Because AI, as the word says, artificial intelligence, right? So a lot of companies that have been built on, there are a lot of very good companies that are built on natural intelligence historically. Now, artificial intelligence is coming, has dramatically come in. So even a calculator that was probably invented 50, 60, 70 years ago is a form of artificial intelligence. We are adding 2 plus 2 by a calculator is also an artificial intelligence. And then I don't know whether you've seen, I don't remember a movie, Hollywood movie, but showed like there were people who were called computers. NASA would hire people who were called computers who would not just calculate, but they could, do very fast, complex mathematical equations, and they were called computers. And then computers came and then displaced the need of all those people. So if a company was providing those services, then that got displaced by a computer. So now artificial intelligence, what we call today, is a big leap forward by this artificial intelligence that's been going on for many decades by different names in terms of what it can do that until now only humans were doing. But it won't be able to do everything that humans have done. So you just have to be evaluating, if there are business models that are built around a form of natural intelligence that could be substituted by artificial intelligence, like calculator or the computer, then those business models you have to, besides some others, be more careful.
No, a point well taken. So staying on this point, you're saying two things. One is that you said, we have, you mentioned Warren Buffett and a bunch of other global investors buying into media companies when stocks went down. By the way, Buffett also bought regional long after Washington Post, etc. He also bought some of the regional media players in between, and then he sort of exited. But in one of the meetings, I remember he said that he just bought it not because of any great sense of business, but he was just emotionally attached to the media business, and he thought there was a case to be made for regional media players. But be that as it may,
just by the way, I was referring, I had someone else in mind who had bought big time newspapers. I don't even know whether Warren Buffett bought after 2000 or not, but there was another firm that had bought big time 50-60% of the portfolio in newspapers. So I had that one in mind.
Correct. Even here, I mean, HT Media is available at, I don't know, maybe 500, 600 crore valuation, but there are no takers. Anyway, my point is that, from a stock market perspective, whatever AI means, and the sum and substance of is, as I understand, that this is going to be a slow sort of a transition. Most of the bankers don't believe that they're going to dump it and start plugging into AI systems from tomorrow. And Charles Darwin has told us everything is evolution, and this is such a big change that it is going to evolve, and people will get their exit opportunities. Of course, some will get at 20% down, some might get at 80% down. That's a different story. The real question from an investor perspective today, because there was so much interest not only in the large caps but a lot of mid cap companies in IT, is the price really at a point where you can bet on them as value? Like in some of the media companies, because even by historical measures, there have been substantial periods where IT companies have traded at much lower valuations than what they are today, even after the recent slump we have seen. Where do you stand on that? Are prices really capturing the kind of growth impairment? I don't know what to call it, like a deceleration or some slow growth that we are expecting over the next few years?
So assuming the questions for me, Mahalakshmi, first of all, it's very, very hard. We think it's impossible to say whether at the sector level, the prices are already capturing, because we just know, as I said, good to have a healthy, very important to have a healthy form of level of doubt. So if we say, yeah, it's already fully impacted and all, then I'm contradicting myself. But at the same time, we don't want to take the other view as well, that there's a lot of downside in the sector, because who knows, we made, I think a team did a fantastic job in 2017, as you alluded to in the past. The multiples have been a lot lower in 2017 timeframe when we started White Oak. Actually, we got some gem of investments when the multiples were low double digit cash flow multiple, not earnings multiple, but cash flow multiple on some fantastic companies. And right now, despite the big fall, we are not there, but not necessary that we get there. So we continue to invest selectively at all points in time. We apply ourselves to see, okay, even with this risk, which companies can do relatively better.
Right.
Yeah, there could be a variety of dimensions on which we would assess to see that, okay, let's say strong management execution as an example. Yeah. So when volatility is higher, at that time, importance of a stronger management is all the more drives home even more powerfully. So we continue to invest some of the mid cap top execution led companies, and look, there'll be net for mankind, it will be supremely positive, and for the equity market also, it will just like .com or internet turned out to be very positive over the last 25 months. Immense wealth creation has taken place.
Right.
Similarly, AI would be as well. So not everything, I don't want to uncertainty. I want to just re-emphasize, doesn't necessarily mean just risk and downside. It is providing on both sides, and we remain open even in IT sector to evaluate. And we are invested today also in select IT companies.
Fair enough. Arun, you can take a shot at IT valuations. Do you think they are at a level that because you said it is overblown? Are they at levels that make you feel that a bounce back you can play a bounce? Secondly, what you said, risks are dissipating in certain quarters, and you're constructive. Today, given the flow situation, I think one of you mentioned that foreign outflows has been. I think you only mentioned that foreign outflows has been a factor in determining the course of markets. The more outflows happen, the less is the chance that it will impact markets in future, because a lot of selling has already happened. I always feel more optimistic that itna paisa abhi chala gaya to abhi aage itna zyada kahan jayega. So you feel more optimistic about it. On the contrary, one change that is happening, we've taken this inflow into mutual funds and SIPs as granted, but as last month's numbers would show, money really chases performance, and Prashant always talks about this, and all the money seems to be was seemingly chasing gold and silver because the performance shifted there. So there is no guarantee that even under the mutual funds framework, where now you can invest in gold and silver, and now also in commodities and REITs, and that market is also going to present a lot of opportunities. Should that also be questioned? Is that an area of uncertainty we are completely ignoring?
You actually asked a lot of things, so let me go one by one. See, IT, I don't want to again get cornered on this, but IT valuations, I mean, Prashant has said whatever it had to be said. I mean, valuations have corrected. They are probably the lowest they have been for a while. But the valuations have actually corrected more in companies which have anyway not been growing, mostly the large companies. There are some select mid caps which were doing quite well, and they were enjoying these high premium over the sector. And typically when uncertainty happens, this risk premium goes up, equity valuations come down, and that actually obviously impacted those IT companies. So the mid cap companies bore the brunt of the fall this time. I don't know whether we are at the end of it. There obviously is going to continue to remain a lot of noise, and one will have to wait and watch and see how the management themselves start to present their case going forward. As far as we are concerned, we are very light on IT. In fact, we don't have anything, but that's just been an afterthought. It's not that we didn't get caught in this whole whole tsunami. We did also bear some of the brunt, but we have kind of decided to stay out of IT for some time and get into some other sectors where we believe there are certain tailwinds, both in terms of valuation and where there is some more certainty or visibility of growth. For example, the pharma sector has not done well at all. It's not done well for the last two years. And valuations to a large extent have seen reasonable correction. I'm not saying across the board. Pharma is still bottom-up sector. There are certain pockets which have looking interesting. So that could be one sector which one could look at. Autos, despite this massive outperformance we have seen, and are again not very expensive, but given the fact that there could be some collateral damage on what happens to jobs going forward. Autos could be one segment which could spare some kind of brunt of the impact of this IT shakeup. But having said that, again, there are certain bottom-up ideas which we think are presenting itself and quite reasonably good, because autos obviously has been one of the biggest beneficiaries in terms of the GST rationalization, and going forward, we think that should continue to do well, both as a sector and in terms of stocks. Similarly, there are certain pockets, sectors which we think should do well. Banking, for instance, which Sandeep briefly mentioned, credit growth has picked up, and while the sector has done incredibly well last year, we still think that there is both some value, not all of it. I mean, most of the value has actually been taken away due to the outperformance last year, but there is some value, and with the tailwinds in terms of growth and the high quality of advances. So that could also be another large sector which one could look at. There are, like I said, there are many other sectors, and some people obviously like to play the tariff, the tariff uncertainty going away. People would probably focus on some of the other sectors which are primarily impacted by the tariff hit and things like that. So overall, there are certain pockets. There are many pockets we think could do well in 2026. But again, like I said, we've always been a bottom-up investing fund, and we'll continue to do that. It's very difficult to go like 23 or 24, where you actually buy anything and anything works. So it's obviously going to be you have to pick and choose and get into the right sectors.
Right. Thanks, Arun. That was a good sectoral overview. One thing I wanted you to answer, but now we'll...
I'm sorry, I'm interrupting you. The thing I didn't answer about was on the fund flows. I will answer it later if there is time. You asked.
Yeah. So we'll come back to your view on it, but maybe Sandeep can start with that. The reason I'm asking this question about fund flows is because of this flow, a lot of people in the market actually, this narrative sort of gained ground that, we may not, do not benchmark current market valuations with whatever else you have seen in the past, because this is a huge structural change that we have seen in this economy, where domestic investors were actually putting in money in equity, and this has become like a savings vehicle of choice, and you may never go back to the mean valuations we saw earlier, supported by the fact that India's macro fundamentals are also a little better in terms of, oil dependence and, all of those things, renewables becoming a bigger share, some of those structural changes. So Sandeep, do you believe that today, the way we think about valuations from a macro approach, from the fund flows, putting all these pieces together, would you review the overall valuation framework?
Yeah, so I believe that every bull run brings a story around why this time it's different and it's going to sustain, and then all of us get a reality check. That's the beauty of the equity markets. So I do believe that we need to take a relook at the valuation frameworks, but it is business specific. For instance, IT, the most direct business which is likely to be impacted by the by the advent of AI, and as the AI advances, we do believe that in the short term some IT companies may benefit massively, but long term assessment is still uncertain. So therefore, you will not be able to really take a call of premiumizing a business, even if it were to do well because of the adoption of AI by certain IT companies, and implementing it for their clients. So it's going to be very business specific, but I do believe that the flows that you spoke about, partly the structural thesis remains. The kind of equity culture and the mindset that has got built into now the hinterland India, it seems to me from whatever conversations we have that's going to sustain. The opportunistic investing into bullion, especially gold and silver, actually happened in a very reactive way. The prices just shot up so much, and then people thought missing the bus. And there is also one more thing that you have to factor in when it comes to Indian households, that they consider a gold, even if they were to buy gold at $5,000 and tomorrow it becomes 4,000, gold becomes, then the color of the gold changes from a investable asset to a permanent asset, which goes into your lockers. So to that extent, I would say that there is some bit of that structural strength of domestic flows is intact. It can just keep going up and down because of these volatility of the markets, and bullion being springing up a surprise. Sectorally, other sectors have also seen actually a decimation of valuations. uh, for example, specialty chemicals, we believe is really undervalued today. Good companies and a whole bunch of good companies have seen a massive derating over the last 2 years. And optically, the valuations of many of these companies look expensive because there has been a very
Earnings
significant
decline.
earnings compression, which is likely to change. So we do believe that that's a very good place to look for opportunities where there is a combination of a growth, a relatively less uncertainty, and also a good valuation, a good reasonable valuation, of the entire sector. Likewise, pharmaceuticals in certain cases, not everything, but I agree with that. So yeah, so it's a mixed bag as far as valuations are concerned, but one will have to be on. If you ask me for a overarching comment, I'm sure we are doing it, and most others are doing it, that they would look at and revisit their at least their entry valuation frameworks.
Understood. So this is ultimately, this is the crux, right? Like identifying whenever there is a shift like this, we've seen this sort of recalibration in markets over the last, last 12, 18 months. Where is it that wherever you've seen growth plunges, you pointed to a very beautiful example in terms of specialty chemicals. There also, the narrative during the boom time was very, very strong that if we only become XYZ part of the global value chain, our market will be so huge. And nobody was talking about destocking and all those risks, because there is cyclicality to any chemical. So, one round of question in terms of how do you identify, each one of you, if you can articulate on your checklist in terms of how do you make up your mind on what is a temporary sluggishness in earnings, which will resolve over a 2-3 quarter period or something that you need to permanently change your view on, and how do you play to these signals, Prashant?
Prashant, you're in mute.
Sorry about that. So that pertains, Mahalakshmi question, I believe, to our just stock selection approach, if I'm not mistaken, right? So correct me if I'm wrong, but on that one, see, not very different from what most managers would say, that we look for great companies at attractive valuations. One can say it in different forms, but that's the bottom of it. I mean, it's a age-old profession, and there's no silver bullet. The devil lies in details and how you execute. So in terms of what we consider, or what are the virtues of a great business in our mind, is one, it has to have a superior returns on incremental capital. So looking forward, the capital should be able to earn superior returns compared to cost of capital. The higher the returns compared to cost, or the average, the better it is. Now, the past does serve as a guide, but cannot be extrapolated to the future. It's important to understand the past and then see how much of it is relevant for future. And scalability, which is whether the business cash flows can outgrow the average growth. So superior returns, scalability would mean whether the company can expand the scope of its offerings or can gain market share, very importantly. And when you have the opportunity for the first and second, superior returns and scalability, very crucially, the management, whether it has the execution DNA to deliver on the first and the second, and also governance DNA, first and foremost, so that the cash flows generated and the value created would be shared with us minority shareholders in a proportionate manner, in a fair manner. So those are the key attributes. And then the valuation, if all this is there, but valuation is already more than priced at, then you don't make outsized returns from that. So you have to look at an attractive entry point, otherwise stay on the sidelines.
Sure. Prashant, my question was a little different. My question is, essentially when you go through a period of earnings slump, like we have in the last few months, and some of the businesses started showing some signs of earnings deceleration much before that. For example, the chemicals, specialty chemical sector. For example, today, let's say some of the consumption businesses, let's say QSR business is,
Yes.
it's very difficult to make up your mind on, it's not really reviving. So now, is McDonald's or Westlife not a great franchise? It's a fantastic franchise to my mind. It is, it has the ability, it has generated high ROE in the past. Now, is this something that how do you make up your mind on, is this a structural shift away from these, or is this a temporary blip and you should play the earnings power in future, it'll come back? Is that just a matter of conviction and gut, or is there a framework or a checklist you put it through?
Yes. No, and sorry, but I would use the same framework since I've already spent time on that one. So see, the value of any business is present value of future cash flows, not next year's earnings or anything, right? So if some of the names that you mentioned are the sectors that Sandeep and Arun mentioned, and we also have fairly good representation in like healthcare, consumption, also industrials, and bottom-up stock selection basis, these are fertile grounds for alpha. So for when we evaluate any of these companies, let's say consumption, a lot of consumption companies are barely growing right now, right? Or some of them have had negative growth also year over year in this reported quarter. Now, is that realistic to extrapolate into future? An important thing we assess is whether they're losing market share or it's just the industry is very soft right now. And if they are not losing market share, in fact, some of them might be gaining a modest amount of market share, then you have to, well, unless there's a competitive or a substitution risk to that particular category, you have to assume if India were to, the base case, we believe the market for the valuations to be where they are, that India would continue to grow over the next 10, 20 years at 5 to 6% real GDP growth rate. Now, if India were to grow 5 to 6% real GDP growth rate, it's been about 6% last 20, 30 years, and at 5 to 6% only GDP, real GDP growth rate, it's hard to extrapolate that consumption as a whole would be, low single digits or zero or something. Right. So this is, where is the trend line? And there is a bit of art and science both to it. And we would in future normalize that top line and cash flow growth from, let's say, flat today or negative or small positive to more commensurate with what is commensurate with 5-6% real GDP growth over the next 10, 20 years. And on that basis, see whether there is value in the business.
Fair enough. Arun?
Yeah. Prashant has already said so much and he's put up a wonderful treatise on how to invest in what are the should be the methodology. I don't know what else I can add. I mean, really, those are the exact.
Well, maybe you can probably talk about some of the other businesses which sort of which at the peak of this bull cycle were like highly valued, like some of the industrial sectors, things like defense, which are technically the growth sectors. They have short-term as well as long-term, tail growth. How do you revisit those assumptions? For example, defense. Sandeep, I want Sandeep also to talk about the defense trends. One of the things is that defense spends are increasing all over the world. In India, it is increasing now. HAL is, also has said it will diversify its client base, etc. The question is the ability to execute, which is what a lot of people have been questioning, that, do they have the capability to execute? They can take on orders, but the execution trajectory should be able to support high growth, which is where they might head into capacity constraints. So in such areas where you can see the growth opportunity is visible, but it's not easy to scale up and grow. How do you revisit the assumptions on growth and valuation?
That's for me or Sandeep?
For you, and
Okay.
I wanted him to
Okay.
take the defense part specifically since he talked about it, but you can talk
Yeah,
about
sure.
industrials and other
Oh, yeah.
sectors the way
Yeah,
you
yeah.
see
So
it.
I add a bit, and then Sandeep can take over. So essentially, the two sectors you've actually mentioned, defense. Probably add one more, the railway sector. I mean, which is also
Yeah,
very similar. I mean, ultimately, these sectors suddenly came out of nowhere and started getting traction because there was a recognition that the incumbent government is actually making a big push towards these sectors in terms of the basic infrastructure had not been added for a long time, and spends were quite modest prior to 2014, and I think that the recognition started coming probably towards the late 2018, 19, 20. I don't know wherever, and these sectors obviously got momentum. But obviously there was a risk that obviously then people went on the same thing, and like they do for industrials, they look at the order to what do you call it, the order to bill ratio, and that's how these sectors got noticed and went to these heady valuations. But ultimately the problem was, and probably still is, that it's a single user. The user is one user, and you have multiple companies trying to get to the same user. So that could be one bit of risk. Having said that, what has changed between last year and before last year and last year, that Pahalgaon happened. And then after that, I think things have become a bit more structural, and there's this belief that the defense sector, particularly, will obviously see a lot of momentum within the next decade or so, and that excitement, in some sense, has returned, especially after the sector had kind of plateaued prior to that. So to some extent, I think that excitement also has both the cyclical undertones in terms of topping out, and then now it has taken some kind of structural undertones of people starting to believe in the sector a little more. So people will then again start to give some disproportionate valuations at some point in time. Maybe it is investable at this point in time, but one has to be cognizant of the fact that it's not something which is going to be secular. It's going to have ups and downs. You're going to, like you said, execution is going to be a big problem. Capacities are not there, and so you could not see a steady trend of growth in all these companies. So that's the thing. As far as our fund is concerned, there's these opportunities we look at, and we have capitalized on it at times. But it is always best, like Prashant mentioned, to go into proven companies which have a track record, people who will never let you down, like the defense, the player which actually never lets you down in that company, in that business, and things like that. So that would be probably my small bit of addressing the two sectors which I had some bit of knowledge on. Over to Sandeep, I think.
Sandeep, especially defense, and I think the other one you were talking about was supply chain diversification. So, for example, EMS today. I mean, these are the sectors that have been seen as the growth sectors in the economy, which have long runway of growth, etc. And some of them, of course, specialty chemicals proved that it is cyclical. I mean, there might be a structural opportunity, but these businesses tend to be cyclical. How do you? Is there? Today, do you approach these businesses differently from, let's say, 18 months ago?
So we'll go maybe sectorally, because that will give you possibly a better color. So defense, I won't say 18 months ago, but till about 2.5 years ago, we would view defense uh, exactly as Arun said, that there will be lumpiness in business. Orders may come, but then from award of the LOI to actually supply of the goods can be a big lag, and there are always delays. All of that was true. What we have witnessed in the last 2.5 years is that both for reasons that Arun mentioned, so I won't go into that again, but we've seen that there is a far more impetus on indigenization of the defense content, or the content that goes into defense hardware. And simultaneously, not because of not because of any planning, but out of default, the world went into a disarray. There have been constant conflicts. If I were to give you one statistic, uh, the 155 shells, which basically are used, if one were to replenish the shells that have been used so far in various conflicts, just to the normal inventory levels, which before, in peace times, what are maintained, it would take the current global capacity, it will take them 3 years. So what we are seeing in Indian defense is an opportunity to also kind of, create that, de-risk their business away from only being suppliers to Indian defense to also being part of the global supply chain. That is one. And number two is there is also, we are moving beyond, like HAL is a normal, okay, HAL builds the aircrafts, but who builds the engines, and if who builds the engines, then who does the metallurgy, the super alloys. So there is a complete value chain where there are multiple opportunities, we believe, which are investable. Having said that, valuations have become a concern for some time. Now, of course, in the last, maybe few weeks, there has been a moderation in valuations, but otherwise, opportunities will be there. Valuation will. I do believe this is all structural. On the other hand, the other industry you mentioned, EMS. EMS is basically more driven towards, creating your, supply bases over here, largely for domestic consumption. We were completely reliant on everything which was, being assembled in China. So, there is but you have to be mindful that EMS margins are very, very super thin. And you require huge amount of investment. So there I would obviously be, and that's where you've seen massive derating in the valuations of some of the large EMS companies, because there are wafer thin margins, and any little, even some amount of slippage can lead to the entire profits being washed out. So there are two different, I won't call EMS as structural. From a margin perspective, I don't think margins can really, go north from here. Structural to the extent that the government wants to obviously push that agenda, and therefore, but it also requires a huge investment cycle.
Right. Thank you so much, gentlemen. That's all the time we have. Kamal has already reminded me we are overshot the time. But thank you very much. Very interesting takeaways. We've covered a lot of sectors. And the one thought I would go with is that approach everything with a sense of doubt, because the uncertainties of today are a little more than what we have experienced in the past. But in certain quarters, like Arun and Sandeep mentioned, the uncertainties are also receding, and we can be constructive. On that note, thank you so much, gentlemen, and thank you, PMS AIF, for this wonderful discussion.
Thank you very much.
Mahalakshmi.
Thank you. Thank you, esteemed panelists.